G'day there, everybody. Thanks for joining me as this Monday afternoon market recap. A continuation off from what we spoke about on Saturday in that pro analysis class. We were looking at this week in particular, starting off rather roughly. That was after the close on Friday, where again Trump came out and spoke about the process in which the beginning anyway of additional tariffs on a further 300 billion of Chinese imports. The markets we expected weren't going to like that news. And as you can see today, not only did we gap down, but we also continued to trade lower throughout the session. We did close off from the intra-session lows. However, this translates through to, on the Dow Jones Industrial Average, losing day of about 2.3%. We did close down just over 600 points. And again, we're coming back down to retest a couple of areas of critical support areas. Before we go into some of these targeted areas, I just wanted to cast your mind back again to the fourth quarter of 2018. And very quickly, I just wanted to remind you, of how quickly prevailing sentiment can change. And hopefully you don't find yourselves at this time jumping on board as the sentiment begins to turn rather pessimistic during, a natural sort of correction, a natural sort of retracement back into most likely creating that of another higher low, and again setting the foundation for a trend continuation higher when we take this out more so into an intermediate, but more specifically that of the macro backdrop of these market indices. Remember how most market pundits anyway, back in the months of September and October 2018 were exceptionally bullish. They were expecting the markets themselves to actually jump out, to break out, and to continue above these all-time highs. However, we had a lot of indications during this process, or during this time frame, over roughly this 3-month period, whereby we began at least to become alerted to a potential correction. We didn't know how severe it was going to be. Again, this was flying in the face of really conventional wisdom, as the markets really held and stabilized around this 24,000 area on the Dow Jones Industrial Average. Now, again, rewind to Q4, where not only did we take out ultimately 24,000, but we came all the way back down to roughly 22,000 around December 24th, I believe that was the low. Actually, the intra-session low of this wick down here was actually December 26th. Everyone during this stage, especially in the month of December, was exceptionally pessimistic about the future. It was somewhat Armageddon, and a lot of people were calling for the crash of this market, the continued decline, just as the market itself was transitioning into that retrospectively, which we call that of a V bottom. So again, if you think about sort of the change in sentiment, just how quickly it changed at the top, more and more people became, of course, rather bearish on the market until ultimately there was some very short-term capitulation, whereby essentially you couldn't find a buyer in sight. All of a sudden, the change happens overnight. You get that one white soldier candlestick. Again, a little bit of a hybrid outside day engulfing candle. And really since December 26th, this market has known no other direction other than up. And again, it's a really good way just to refresh, of course, that unfortunately the markets do not advance in a linear line. They go through the ebbs and flows. You see these very strong rallies. You see these pullbacks, which again, if you use Fibonacci retracements, they break them down into sort of ratios. Again, the 38.2, the 0.5, and the 0.618 retracement of this range bound sort of area. If this was to equal 100, I might as well actually show you this very quickly. And I'm going to use this candlestick just here and drag it down to this candlestick back here on the 26th. And you can see that 0 to 1, that equals 100. And it gives us these three ranges here. If I can zoom in close enough, you can see them. You've got the 0.382 again, just to repeat myself, the 0.5 and the 0.618. Now, as it stands, the point, let me just zoom out again, the 0.382 so you can see this, is coming in just below 25,000. It's coming in at 24,813. And on top of that, when I bring up the simple moving averages, you can see that we've actually sold on down and we've closed right in the middle of both the 100 and also the 200 simple day, sideways moving simple moving averages. Now, if I also bring up the oscillators, you can see that we have essentially reset out of overbought territory. So again, if you think about these YouTube updates that I present you with, if you're not in that pro analysis class, I'd encourage you to jump on into it and have a look at the longer analysis. But we began to become a little bit cautious once again on this market, going back as far back anyway as the late stage of February and also March, where it looked as though we had potentially some exhaustion gaps. They never really played out, but it did at least warn us of potentially that sort of top, that temporary resistance area on the markets when when and if, of course, we came back on up to retest it, like we have done on these 2 other occasions, or 3 times anyway, to actually create that resistance area, that there was the probability in which that the market would not be able to overcome it on its first attempt. Now, here we are, obviously at the current juncture, and you can see that we have been in a correction now for a little over 2 weeks. And I'm not saying that we're at the end of, or at that stage of capitulation at the moment. I do believe that this market has got the potential, the likelihood anyway, the probability that we are going to econ down a little bit further. But again, in terms of this current expansion and the expansion that we've been in since 2009, the odds are very, very much so heavily weighted that we are, again, still going to break above these all-time highs rather than breaking down below the December lows. I think categorically anyway, it's probably in the vicinity of above 90% for the continuation of this market into 2019 versus, of course, the breakdown of all of these areas of support, not to mention the prevailing trend lines that have been in effect all the way since 2009. So if you find yourself here a little bit doubtful on the market, I understand that's very natural, but at the same time, try and disconnect yourself emotionally and look at the market a little bit more rationally or logically through the eyes of a technician, all right? Someone who just completely blocks out all of the market noise and a lot of the sort of the bearish prevailing sentiment out there at the moment. Because again, at some point, all right, it's a little too soon to tell really. I mean, the first sort of gauge that we were looking at was that rising 50-day exponential moving average. Across the board, we've now broken below them. This is the S&P 500. We're below that rising 50-day. So it did provide sort of temporary support on Thursday and Friday last week. But you can see again on the NASDAQ, we've cracked below it. And then the next secondary target, as we've been speaking about, are these simple moving averages. So you can see on my screen on the NASDAQ, you can see roughly 7,500. It's right smack bang in the middle of the 100 and 200 sideways moving average here on the NASDAQ. When I show you it on the S&P 500, you can see I've got these targets down here, 2,772. And on the Dow Jones Industrial Average, we have closed on that area as at the closing price on Monday. Now, again, I do expect this market to actually move on down a little bit lower. It is the first gauge. But more importantly, again, pay attention to those Fibonacci ratios. We are very much so in a defined correction, like we've been sort of talking about as this has continued to move deeper and deeper. But as such, it is going to end, right? And when it does end, you're going to see a continuation to the upside very, very quickly. Pay attention to the RSI collectively as well. The Dow Jones Industrial Average, you can see it's actually below this, the extreme oversold reading. It's at 22.2, but we're still allowing, of course, the MACD and also the stochastics to reset. We'll have to pay attention and see whether or not this Stokes is actually going to move into oversold territory. At the moment, we're certainly below the midpoint. So again, we are firmly in correctional type of territory. That shouldn't be a surprise to anyone. And the MACD, again, the slow line is even about to, anyway, push into negative territory. The negative territory. The histogram bars are certainly accelerating still to the downside. Today, of course, is going to help that. Of course, being Monday's session with another relatively bearish day. Anywhere down between 2.3% on the Dow Jones Industrial Average up to about 3.4% on the NASDAQ. But again, you can see collectively the Stokes is pushing below the midpoint. The RSI is extremely oversold temporarily on the RSI and the MACD, which is good at the moment, although it is technically bearish. It's allowing, of course, the shakeout to occur. This shakeout shouldn't be unexpected to anyone. Again, we became a little bit worried and cautious of this type of move a couple of months ago. As such, we've still continued to trade all the way back up into most recently resistance areas. You can see on the S&P 500, 2,926. Some people culled positions, others kept the entirety of that position open. As you can see during this, I just moved my support and resistance line. Let me just undo this. But as you can see, during this retracement, it has negated a lot of those past profits over the past 1.5 months. But when we stabilize, okay, you're going to have an opportunity to go long if you haven't already done so, if you're not already sort of buying into the sell-off. This is going to be a gift from the market for those who step up to the plate and have the courage to act. Really spoke about that, or at least tried to over the weekend, especially on Saturday in that analysis class. And again, although we haven't seen the signal of a reversal around these lows, we are expecting this to show up. And the best indication of that is going to be these oscillators as they move into oversold territory mixed with some of these targets that I have on my screen, which is correlating around those sideways moving simple moving averages, those longer term simple moving averages. Although at the moment, it's not a definitive target, albeit what I mean by that is we're not looking for it to tag it to the decimal point and then to see a quick and sudden reaction. We're looking for areas of confluence of support whereby there are multiple areas of support that are going to overlap, which may provide ultimately that reversal point. As it stands, we're on the precipice of actually breaking below the swing low, or one of the actual swing lows, or the highest swing lows anyway, towards the end of March. But the major one to pay attention to is the swing low earlier in the period of March. If I flip on over into the Dow Jones Industrial Average, you can see that we have taken out that late March swing low or higher swing low relative to where we were at the beginning of the month. And you can see that we're only just barely above it at the moment. Now, for those of you who listen to this YouTube channel, I've already floated this a couple of months ago, and I'm going just to repeat this one final time, and then I'm going to call it as at this Monday afternoon market recap. But this is very important because I've already tried to front run some of the prevailing sentiment and some of the price action, which we were sort of hypothesizing about a couple of months ago. And you can go back and listen to this. I cannot tell you specifically what date it is, but I can tell you, I guarantee you that we have spoken about this ad nauseum at times. But we were talking about two different sort of portals in which this market would move, whether or not we get the definitive breakout, the retest, and the continuation. That was portal number one. But also more specifically, and more importantly at the moment, more pertinent to the current price action, is that portal number two was that we actually move on up. On some of the markets anyway, we created a new higher high, which opened up, all right, the bigger sort of retracement. And what I was speaking about was, imagine if the markets themselves did a head fake whereby we take out the swing low temporarily. A lot of people look at this as the signal to go net short, and around that critical juncture would be that critical reversal whereby the market stabilize and then accelerate again and continue back on up in the overall prevailing bullish direction. And I think that has a very high probability of playing out. We floated the idea a number of months ago, and again, just to recap, whereby we take out some of the swing lows, a lot of people begin to panic, all right? They see the swing lows being taken out, and as at that time, which again, if you look at it now based on the Fibonacci support and at least support areas, not to mention some of the others, just horizontal support areas, you can see how it sets the stage essentially for a lot of novice traders to actually begin shorting the market right at the opposite time, because really they're just obeying really their textbook definitions of trend reversals, okay? So think about that. It hasn't happened yet, but I'm not going to be surprised whatsoever if it does occur. Again, we've spoken about it in the past, and I think given, of course, the price action which has flowed through to Monday, and again, some of this fundamental information that clearly market participants are not happy about, it sets the stage for, again, the building of worry in the world of active market participants, people to do largely irrational things. I do believe, of course, that this is going to unfortunately speed up the process of that macro reversal, which is ultimately going to happen. It may sort of solidify it more so in 2020, but for 2019 at the moment, as it stands, again, we're not looking for this market at all to begin taking out any of these macro sort of technical strongholds really on the technical chart. I've seen a few comments of, well, where is structural damage actually, like where does it occur? How do we know when structural damage has actually happened? And the structural damage is essentially the trend line from 2009. So this trend line, it's been in effect for 10 years. And as you can see, even after this retracement that we have been in, it's now over 1,000 points to the downside since the peak up here at 26,664 down to where we are at the moment at 25,328. We're looking at about a 1,300 point move. I mean, ultimately, no technical damage will be done unless we break below 23,500. This bull market is still intact, technically speaking, as long as we hold above this trend line. Again, on the S&P 500, you can see why it's a magnetic color line. It sticks out. That is the line in the sand. So again, not that I'm saying that the market is going to come all the way down to here. In fact, I don't believe it will after the retest back in the month of December. But this is all technical support whereby we can retrace on into this area, even though we're not looking for it to move that deep. And then continue in the direction of the bullish trend. All right, so the line in the sand of technical damage is down here at roughly 2,500 on the S&P 500. That's 311 points from where we closed at as at Monday. And then just to show you this, or at least technically speaking on the NASDAQ, it's going to come in below 6,250, which is a very long way away. I still think the NASDAQ is going to move all the way up to roughly 10K. It may even shoot this. And again, what's happening right now is that the market itself is trading on a discount. It's trading on a discount as it did back in the fourth quarter of 2018. Although, again, we don't have the signals of the reversal and the continuation to the upside. They're going to set up, whether or not it's tomorrow, whether or not it's next week, or in a couple of weeks' time, the market is giving you an opportunity, once again, to really push out the option expiration if you're trading, say, the Qs, or if you're jumping into the SPYs. You don't necessarily have to do it now, but again, each and every day it drops lower. You've got the opportunity to at least, place your stake in the ground, so to speak, and to act and then to hold, ultimately, as the market reverses and then continues. All right, so I just wanted to speak about that as at Monday. Go back and listen to those videos if you want. We spoke about, again, the overshooting to the downside, the false whipsaw that it would provide, which would then set the stage for a pretty big short squeeze to take out the most recent all-time highs that were at least established on the S&P and the NASDAQ. It never occurred on the Dow Jones Industrial Average. We did have some temporary short-term, right, into market divergences, okay? So again, that's going to do us as at Monday. Receiving a lot of emails from people. It's sort of, I was mentioning this to a few people as well in my email responses. It's a really good sort of contrarian indicator, because generally what happens when the market is in a very low volatile sort of state or an environment anyway, and the market's just trending, people are just, I wouldn't say they're complacent whatsoever, but they don't have an initial sort of reaction to email and ask questions, whereby when we transition, and I mean, if you just think about this, we haven't really even moved all that far, really. It's just sort of a little bit of a shock to the system when the market actually moves into a retracement. But anyway, my inbox, I mean, it begins to sort of catch fire with all these sort of emails coming in, which is fine. It's brilliant. I really like it when I receive these emails. But again, it works as a contrarian indicator, because I look at obviously what the question's being sort of proposed, and then I think through it obviously a lot. And there can be gaps in understanding of analysis and trends and things like this. And again, it just reminds me, or I think anyway, how it can act largely as a contrarian sort of indicator. So this is the time again where most people do nothing. It's where essentially they'll actually close out a lot of long positions for a loss, or at least they'll begin to go short right at the wrong time. Not to say that this is the end of the sell-off, but again, the lower it goes, the more sort of bearish people become naturally, whereby you're getting closer to the actual bottom before the market continues to rise again. So we'll keep an eye out for those continuation signals. There's nothing, all right, that has shown up at the moment other than some of these oscillators being oversold and some of the markets coming back down into at least to retest the sideways moving, simple moving averages, most specifically on the Dow Jones Industrial Average. At the, aside from that, really, the bears are still firmly in control of this market. And as it stands, just be a little bit patient out there. Don't do anything rash. But again, it is another opportunity that the market is giving you, like it did in Q4, to actually enter in at a really supreme sort of discount prior to, again, the continuation higher. So that's going to do us as at Monday afternoon, everybody. Enjoy your evening. I'll be back with you later in the week to recap some of these major fluctuations in price on the US financial markets. All the best. Goodbye.